blue chip property versus growth property. So as you know, Felicity and I built a reasonable portfolio when we were kids in our 20s. We lived in a pretty cool suburb in Melbourne, Elwood. Lived there for a couple of years. And people always, we lived in this Art Deco apartment, which is close to the shops and close to the beach. And people always ask me why I never purchased that. At the time it was around 700,000. Instead, Felicity and I, what seemed like Shitsville, bought properties in the outer suburbs, like multiple properties in the outer suburbs, and rented where we were. And that was because a number of factors around that blue chip property versus the type of properties we pick that get really good growth over the long term. And I know you're very versed on this, so I'm just going to get you to tell people about what those main differences are and why Felicity and I would have taken that choice and why our current clients take that choice.
Yeah, and I've done exactly the same thing. So I live Bayside in Melbourne in what you call a blue chip area. My own home would make probably one of the worst investments going around for a few key reasons. So let's unpack them. Number one, the price to enter. Okay, if you think about how borrowing capacities have been impacted as the interest rate rises have happened over the last couple of years, everyone's borrowing capacity has reduced. And what drives growth in properties is always supply and demand. So if you've got more demand at a more affordable price point, as opposed to a premium price point, you're just going to get more growth more consistently. That's the first one. The big one really is, I'll take a step back. The big one is holding costs.
Yep.
But what people need to understand is successful property investors think about a portfolio and how you can hold as much asset as possible for as little money out of your own pocket as possible.
That's one of the keys to wealth creation, isn't it? That's 100%. One of the serious keys to wealth creation.
Yeah, because one of the most common mistakes people make, and we know this from the data, is that those people that buy one investment property and get stuck on that typically buy in the same postcode they live in. So, they know an area, they get emotionally attached to it, they make an emotional based decision, they end up paying too much, but most importantly, it hamstrings their cash flow. And what we mean by that is the higher your purchase price, the lower your rental yield, and more than likely the property that you're going to buy is going to have significantly less tax benefits, like 10,000 or more less tax benefit than what a quality property in a more affordable location will give you. So if you think about side-by-side comparison, you could hold one blue chip property for 4 or 5 affordable properties for the same money out of your own pocket, then you're going to be at least 1.5 million, probably more like 2 to 2.5 million better off side by side with the affordable portfolio over 10 years.
I know your biggest challenge, and for the last 20 years, we've dealt with so many different sporting athletes, AFL players, NBA players, NBL players, A-League soccer players, jockeys, professional surfers. Yeah, I know, they gather up over the time. But I think probably one of your biggest challenges with that conglomerate of client, and also the high-powered execs, which I know you deal with and the team deal with regularly as far as their investment strategy is, they all want blue chip. They've got this feeling that they need to be investing above the level of the general population because they are, in their eyes, above the general. Yeah, it's a status thing, isn't it? And it doesn't matter whether you're a high-powered exec or you're a professional sporting athlete, they are alphas in their own rights, male or female, alphas in their own rights.
Yep.
What's the sort of challenge? Give us some examples.
I'll give you one from literally in the last couple of weeks. So Jaden works at one of the big investment banks global investment bank, works in Australia. The conversation first went something like this. He got introduced to us by a friend of his who's a client. He said, "Oh, Michael, I've been looking in Sydney for the last 12 months. I can't find anything with a decent yield." I said, "Absolutely, that would be a problem. What's your concern around that?" He said, "Oh, well, the cost to hold is just too high." I said, "Exactly right." Bear in mind, this guy literally analyzes companies for a living.
Yeah,
down to the dollar.
I know the guy you're talking about. So he analyzes companies that the big superannuation funds use that analysis, and he earns well over $1 million a year. So he's obviously fairly analytical. And so,
spot on. And we just said, okay, so maybe consider this. If your holding costs on that property in Sydney, if you can find something for value, right, that's going to be about $800 a week. Okay, and he agreed that wasn't a good ROI. We were able to map out a portfolio plan. In short, in the last couple of weeks, we've mapped out where his first 3 properties will be. 2 of those are under contract. Next one will be next week. And in 2 months' time, once his finance approved on those, he's got some income coming in. Then we're going to be able to get number 4 and number 5. and his holding cost in total is going to be more than $100 under that $800 a week. So he's holding 5 properties diversified around Australia in different markets for less money out of his pocket than that one property in Sydney.
And what's the value of that five properties versus that one property?
So that one would be about 2.2 mil in Sydney, and these collectively are about 3.75.
So you're holding about 30% more asset for less money out of your back pocket.
Exactly right.
And they'll get a better growth rate.
It will.
There you go. So I'll give you one more tip. And this is really where the difference between a rookie wannabe investor and a sophisticated investor is really understanding the system and how to beat the system. So I made it a life goal to beat the financial system. So to shake off the financial shackles that society places on us. So to understand the financial system and then to beat it, you really need to understand way valuers work. So if we're buying blue chip, we're buying usually in areas that are above the median house price. As opposed to a growth property, which you want to get as much growth as you can, and the faster you can get that growth, you can use that equity to duplicate.
Spot on.
So what people need to understand is why we always advocate for buying around the median house price or slightly under if you can, is because of the way that valuers work. Now, I'll explain this really simply, but valuers, the way they come in, there's 3 types of valuations. There's the walkthrough, which is the $10 million properties. There's the drive-by, which is sort of the median house price properties. And then there's the desktop, where they use RP Data Price Finder, which they basically don't leave their desk. They just look at comparables and whack. So that's a sausage factory, basically the way they turn out their valuation.
They're not perfect assessments of market value.
That's right, And a valuer's valuation they put on it is usually below the contract price, because the difference with the bank says, what can I sell this property for Monday morning, as opposed to what can I sell this property for in a 90-day sales campaign. But let's think about beating the system. And this is where people really need to understand the system to beat the system. So if we can increase the valuation of our property portfolio every time we go to duplicate, we can get a little bit extra milk out of it. If we're buying in blue chip areas, there might be a 4-bedroom, an expensive area. The valuer comes in, they're lazy, sorry valuers, they're lazy. They come in and they go, 4-bedroom around that area is about that price. Yes, I'll put that valuation on it. So they'll stick a valuation on it, which is conservative. If they're looking at your property that you've purchased in an area which has got similar properties to it, and this is where it gets really strategic when you're buying the right type of property in a specific area. If you're buying a property, a 4-bedroom in an area, but you've bought it underneath properties that might be a little bit larger in land size or a little bit larger in, it's got a media room. So they're sitting at the median house price of 4-bedroom. You've got one 50 grand lower than the median house price. Here's where the trick comes in. The value is lazy, and when you're buying it, they might come in at your contract price. 2 years down the track, when you go back to revalue your portfolio that's just sitting just below the median house price, you pick up 50 grand there and 50 grand there and 50 grand, because they just lazy and they put it up to the next median house price, similar sales in the area. So you've created, and it's not fictitious, it's real equity that you've created, real money you can use to go and get another deposit. So understanding the way the financial system works, knowing that and working out how to beat it is why our clients are able to hold more asset for least money out of their back pocket.
There's one last thing. This one's really important as well. In a top-down market, that's basically money is cheap and the premium end of the market gets pulled up because with record low interest rates, everyone can afford to borrow more and FOMO kicks in and they upgrade. In a bottom-up driven market, all of that supply and demand and affordability pressure is happening at the affordable end. So I don't know whether our team can overlay a graph on top of this while I'm talking, but in case they can't, let me explain it. When you look at the affordable quartile of property prices in all of the major capital cities right now, that growth is outperforming the middle quartile and even more outperforming the premium quartile of property prices. So supply and demand, I get it. It sounds boring, guys, but these are the fundamentals that you need to understand, is that in order to be able to build a portfolio, you need to be getting growth consistently. Getting 20% one year and then losing 15% on the median house price at the premium end is not going to allow you to be able to build a portfolio over time, because if your borrowing capacity doesn't allow or the timing's not right, you miss out on that small period of growth. Whereas when you're getting that upward pressure consistently over a 4 to 5 year period through a growth cycle, you're able to duplicate far more easily than what you can with premium property. So
the myth that the blue chip property outperforms properties that OpenCorp pick, owning a 90210 postcode property is absolute just wank factor. And thinking that that will outperform the general market is delusional.
Yep.
Because we've got 20 years of client data showing that we've beaten the market on average by $256,000 per client.
If you're going to get emotional about anything, guys, get emotional about the result. Take the extra $2 million. Love where you live. Invest for returns.